Tokyo is trying to downplay Trump's statement, but does it mean that Japan is next on the US president's hit list?
Japan has quietly orchestrated the largest treasury bond liquidation in modern financial history, $211 billion sold in just 6 months, coinciding with a massive $1.7 trillion drop in US stock market value that analysts increasingly link to Tokyo's moves. Could this represent a strategic pivot, rather than a complete abandonment of the dollar? The simplistic narrative of Japan ditching the dollar overlooks critical elements of this financial chess match between two of the world's largest economies. In the next 15 minutes, we'll examine the verifiable facts behind these market movements, distinguish them from speculative headlines, and uncover the true catalyst behind Japan's significant financial recalibration. What if a single nation could wield its financial influence like a precision instrument capable of sending shockwaves through global markets? This isn't speculation. It's precisely what we're witnessing as Japan strategically repositions its massive treasury holdings. Japan established itself as a financial powerhouse in US markets by 2014, accumulating an unprecedented $1.3 trillion in treasury bonds, making it the largest foreign holder of American debt. Building on this historical background, Japan's recent reduction of this massive portfolio has occurred at a pace that has captured the attention of financial analysts worldwide, representing a dramatic shift in its decades-long position as a cornerstone investor in American securities. The timing of Japan's treasury liquidation reveals a clear strategic pattern. Market analysts have documented direct correlations between Japan's sell-off activities and escalating trade tensions between the two nations. Japan's most aggressive selling periods align precisely with the implementation of US tariffs targeting Japanese electric vehicles. This synchronicity demonstrates that what appears superficially as portfolio management functions as a sophisticated financial countermeasure, a deliberate monetary policy response to trade policy provocation. The calculated nature of these sales becomes even more apparent when examining the execution methodology. Rather than dumping securities indiscriminately, Japan has implemented a systematic approach to its treasury reduction. Financial experts note that each wave of selling has produced distinct, measurable impacts on the treasury market, suggesting carefully orchestrated financial maneuvers designed to send clear signals while minimizing self-inflicted damage to Japan's remaining holdings. This case stands as particularly unusual in international finance due to its strategic motivation. Historically, major treasury sell-offs by foreign nations have typically occurred either during domestic financial crises when countries needed to raise capital quickly, or as part of standard diversification strategies implemented over extended timeframes. Japan's actions fit neither category. The evidence indicates a deliberate use of financial leverage as a response to trade policy, effectively weaponizing treasury holdings in a sophisticated form of economic statecraft. While Japanese financial officials maintain their public stance that these adjustments represent normal portfolio management, the market's reaction tells a different story. Each significant reduction has triggered noticeable yield fluctuations, demonstrating the outsized influence a single nation can exert on the world's most important debt market. The treasury market's sensitivity to Japan's movements highlights a vulnerability in the US financial system that many analysts had previously underestimated. What distinguishes Japan's approach from historical precedents set by other major economies is the absence of panic-driven selling. When China reduced treasury holdings during periods of domestic economic pressure, or when Russia divested American assets amid sanctions, those movements often displayed characteristics of urgent portfolio adjustment. Japan's more measured approach suggests long-term strategic thinking rather than short-term financial necessity. This distinction becomes crucial when assessing the broader implications. Japan isn't simply ditching the dollar, as some headlines might suggest. Rather, it is executing a calculated realignment of its financial relationship with the United States, using its financial leverage strategically, applying precisely calibrated pressure at specific moments to maximize impact while preserving its overall economic position. This represents a sophisticated escalation in how sovereign wealth can be deployed as an instrument of national policy. The apparent disproportionality between Japan's measured financial adjustments and the staggering $1.7 trillion stock market decline raises profound questions about market mechanics. This massive valuation drop, while real, reflects a complex interplay of factors beyond Japan's treasury sales alone, suggesting markets today might be driven more by psychological responses than fundamental economic realities. Verifying the market decline confirms the $1.7 trillion figure is accurate, occurring primarily during a concentrated 3-week window that coincided with Japan's most significant treasury sales. Like a stone dropped in a still pond, these relatively modest treasury transactions created ripples that expanded exponentially across global markets. While major indices recorded substantial losses, the pattern of decline suggests a more nuanced reality than simple cause and effect, though the temporal sequence establishes treasury sales preceding market movements. Forensic analysis reveals an important distinction between correlation and causation. When mapping daily treasury transactions against market indices, patterns emerge, showing market reactions intensifying progressively with each successive sale, indicating that investor psychology was amplifying the perceived significance beyond their intrinsic impact. This psychological multiplier transformed what might have been modest adjustments into substantial valuation shifts across sectors. The transmission mechanism operated through yield fluctuations affecting market sectors unevenly. Growth-oriented technology stocks suffered disproportionately compared to value investments and defensive sectors. This sectoral disparity suggests both technical repositioning and fundamental reassessment of growth prospects under changing monetary conditions. The question becomes whether this represented rational recalibration or excessive reaction to temporary yield pressures. Evidence increasingly points toward market overreaction rather than fundamental structural shifts. Short-term volatility metrics reached levels typically associated with significant macroeconomic shocks, despite limited actual changes to economic forecasts during this period. This disconnect suggests psychological factors dominated trading decisions, with initial selling triggering self-reinforcing waves of risk aversion. Modern markets rely heavily on automated systems programmed to respond instantly to yield curve changes and momentum signals. When Japan's treasury sales began shifting yield curves, these algorithms likely executed simultaneous selling programs across multiple asset classes, amplifying movements far beyond what human traders might have initiated. This technological amplification helps explain the seemingly disproportionate market response to Japan's relatively contained treasury adjustments. Alternative explanations provide critical context. Domestic economic indicators showed mixed signals, with manufacturing data weakening while inflation concerns persisted. Federal Reserve communications maintained a hawkish stance, disappointing investors hoping for accelerated rate cuts. Additionally, global economic concerns, particularly surrounding European recession risks and Chinese growth deceleration, created a backdrop of uncertainty that magnified market sensitivity to negative catalysts. Currency markets offer another perspective. The dollar-yen exchange rate experienced notable volatility, with the yen strengthening following major treasury sales, a pattern consistent with Japan repatriating capital. This created second-order effects across global markets, particularly for multinational corporations with significant Japanese exposure, further contributing to market volatility. This episode reveals concerning fragility in contemporary financial systems, with market responses disconnected from the scale of initiating events, suggesting markets have developed hair-trigger sensitivities to perceived shifts in capital flows due to excessive leverage, momentum-based trading dominance, reduced market liquidity, and heightened geopolitical anxieties. This market hyperreactivity created fertile ground for political narratives that further magnified perceptions of Japan's actions. Beyond financial institutions and investment firms, political figures quickly incorporated Japan's treasury sales into campaign narratives, transforming financial data points into geopolitical talking points. Former President Trump addressed the stock market turbulence directly, making a series of sweeping claims. Japan has just taken a step that could shake the US economy. They are quietly selling off large amounts of US Treasury bonds, an unprecedented move. If Japan continues to sell off US bonds, What will happen to the dollar and the global economy? These statements contain significant inaccuracies when compared with Treasury International Capital (TIC) data. Japan's treasury reduction was transparent and reported through regular data releases, the opposite of quiet. The transactions were executed through normal market channels and documented via standard mechanisms. Furthermore, the characterization of these sales as unprecedented misrepresents historical context. Japan has adjusted its treasury holdings numerous times over decades, though the recent pace represents an acceleration from previous periods. Trump's framing suggests intentional destabilization rather than strategic reallocation, contradicting the methodical approach evidenced in transaction data. His statements appear designed to integrate Japan's treasury sales into his broader economic narrative focused on protectionist trade policies. Throughout his first administration and current campaign, Trump has consistently advocated for substantial tariffs on imported vehicles, including those from Japan. His recent statements connecting Japan's treasury sales to economic instability provide justification for his proposed tariff policies, despite economic analysis indicating his previous trade policies contributed to manufacturing job losses. The Biden administration's conspicuous silence regarding Japan's treasury activities creates an information vacuum. This absence of official commentary allows more alarmist interpretations to flourish unchallenged, like a megaphone amplifying whispers into thunderous warnings. When only one political perspective frames financial developments, market participants may incorporate these interpretations into their trading strategies, potentially amplifying market volatility. Japanese officials have maintained restraint rather than issuing explicit rebuttals. Japan's Ministry of Finance continues to characterize portfolio adjustments as normal financial management rather than geopolitical signaling. This position reflects Japan's delicate circumstance, balancing crucial security relationships with the United States while navigating growing economic integration with regional partners. The political timing corresponds with the United States presidential election cycle, when economic narratives assume heightened importance. For Trump, characterizing Japan's treasury sales as threatening helps substantiate claims about American vulnerability under current leadership. Meanwhile, Japan faces domestic political calculations, with Prime Minister Kishida managing constituency demands amid declining approval ratings. Market data reveals a noteworthy phenomenon. Trump's statements correlated with temporary amplifications in market volatility. Analysis of intraday movements shows that several of his social media posts regarding Japan's financial activities were followed by short-term spikes in treasury yield fluctuations, despite containing no new factual information. This underscores how political narratives from figures with established market influence can temporarily override fundamental analysis. The distortion between political characterizations and financial reality highlights a concerning dynamic: the increasing influence of political narratives on asset prices. Japanese financial data shows continued substantial dollar reserves and ongoing use of dollars in trade settlement, contradicting the abandonment narrative some political voices have constructed. The contradiction between Japan's continued dollar usage and its reduction in treasury holdings isn't actually a contradiction at all. It's a calculated risk management strategy. Beneath the surface of these seemingly conflicting actions lies a sophisticated financial blueprint that responds to Japan's unique economic vulnerabilities while positioning the country for an increasingly multipolar global economy. Japan's financial strategy resembles a well-calibrated investment portfolio, methodically balanced to provide both stability and adaptability in changing market conditions. At the core of this approach is Japan's dramatic 80% increase in gold reserves since 2021. This substantial gold acquisition signals a deliberate move toward hard asset backing as insurance against currency fluctuations. This acquisition functions as the stabilizing anchor in Japan's financial strategy, providing a foundation that allows for more dynamic movements in other areas. Building upon this gold foundation, Japan has strategically redirected capital toward Asian markets, creating a regional financial integration network. By strengthening connections with neighbors like China and South Korea, Japan establishes an economic buffer that reduces dependency on any single foreign market. This regional approach creates natural financial synergies that complement rather than completely replace its dollar-based operations. Japan's demographic challenges add another dimension to its treasury strategy. With an aging population and declining workforce, Japan faces structural economic pressures that necessitate maximum financial flexibility. The country's heavy reliance on exports makes it particularly vulnerable to currency volatility. By incrementally reducing treasury exposure while maintaining significant dollar reserves, Japanese financial authorities have developed a balanced approach that addresses these vulnerabilities without triggering market instability. Expert interpretations of Japan's strategy vary considerably. Some financial analysts characterize these moves as technical adjustments responding to interest rate differentials, while others view them as the opening moves in a more fundamental realignment. Trade economists point to the timing of treasury reductions coinciding with heightened export tensions, suggesting these adjustments may serve as subtle negotiating leverage in ongoing trade discussions. The coordinated nature of treasury reductions, gold acquisitions, and Asian market integration indicates a comprehensive strategy rather than isolated financial decisions. This multifaceted approach enables Japan to maintain optionality while gradually reducing concentration risk in dollar-denominated assets, similar to how a diversified portfolio protects against sector-specific downturns. Despite these diversification efforts, Japan maintains substantial dollar reserves and continues conducting most international transactions in dollars. This continued commitment to the dollar underscores the evolutionary rather than revolutionary nature of Japan's financial strategy, pursuing proportion adjustment rather than wholesale abandonment of the dollar system. The broader geopolitical context adds another layer of complexity. Japan's financial strategy has developed against the backdrop of increasing BRICS initiatives toward alternative payment systems. While not explicitly aligning with these counter-dollar initiatives, Japan's treasury reductions and regional integration create implicit hedges against potential disruptions in the dollar-centered system, providing financial optionality without requiring explicit political commitments. For Japan, this calibrated approach offers significant diversification benefits while reducing exposure to U.S. fiscal and monetary policy shifts. The challenge remains maintaining this delicate balance, reducing financial concentration risk without creating unnecessary geopolitical friction in an evolving international financial landscape. Looking beyond alarmist headlines, Japan's treasury adjustments represent a nuanced financial strategy, not a dramatic dollar abandonment. These moves signal a gradually shifting landscape where global reserve currencies naturally evolve. The significance lies in subtle indicators of longer-term change. Japan's actions may contribute to a gradual decline in dollar dominance while potentially catalyzing greater financial cooperation among Asian economies, fostering a more independent regional system. The true impact is the incremental emergence of a multipolar financial order where U.S. centrality faces evolutionary, not revolutionary, challenges. Will we witness a new balance of power in global finance, or merely a recalibration of existing structures? The answer lies in appreciating gradual transformation rather than expecting sudden disruption.